Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye.
Okay, everybody's panicking about gold. Gold's going to be just fine. Okay, it's not going to be the end of the world. I want to play a clip for you.
And the world is now pulling the rug out from under the U.S. The dollar is going to collapse. The dollar is going to be replaced by gold. Central banks are buying gold to back up their currencies. They're getting rid of dollars. They're getting rid of treasuries. We are headed for an economic crisis, again, that will make the 2008 financial crisis look like a Sunday school picnic. The biggest difference between the crisis that we're about to have and the one we had back then is this one is all in America. It's not going to be exported to the rest of the world. It's not a global financial crisis. It's an American financial crisis.
Okay, so, all right, so we'll address this. But first, let's get to what happened today, first of all, with gold, okay? One of the things that happened is everybody got freaked out because Trump is going to replace the Fed chair with Kevin Warsh. And he doesn't support what they call the Fed put. Every time when the market crashes, what do? They go in and start dropping, start cutting, do anything to move the market up. He doesn't believe in that. That's one reason why we had a problem. So everybody started to rotate quickly out of gold, and they started to go into financials, energy, anything of value, industrials, like Caterpillar, one of our stocks, Honeywell, another stock, utilities, like Duke Energy, consumers, Coke, Pepsi, Clorox, that kind of thing. So that's what happened. Everybody got, their hair lit on fire. And a lot, and I told this to my gang members over the last few weeks. I said, be prepared. I said, we've been getting a small correction, 2, 3, 7%, like clockwork. Every, I don't know what it is, every maybe month and a half or whatever it is. I pointed it out on GDX chart, and I showed him, I drew lines on it and said, look at this, it's almost like clockwork. At one point, we're going to get a big correction, and then it'll go right back up. But because at some point, it's just like Micron technology. One day, you're going to get a 20% correction on Micron because it's called profit taking. The big institutions want to book these profits, so they'll take profits. But there's nothing wrong with gold, okay? There's nothing wrong when the day that Moo gets hit, unless somebody's taking their market share, if somebody's taking Moo's market share, if somebody comes in and takes half, then it's over. But for now, Moo is the only one that really, has that memory market, tied up. So anyway, a lot of it was profit taking today, and when that happened, we had the dollar jump. Now that hurts gold because who's one of our biggest gold buyers? Okay, people that are in Europe. So that doesn't help. So again, when you have that dollar spiking up, that's just really expensive for the foreigners, and foreigners are big buyers, okay, huge buyers. And so that's another reason. And also, again, the other thing is, the concern is that this guy, Warsh, the Fed chair, he's going to do fewer cut rates. We know that. That's just him. That's how he works. And he's going to make tighter liquidity. Now, tighter liquidity is not to be confused. Everybody does this with money. It's not money. Tighter liquidity means that there's going to be just less cash sloshing around in the system. And so but there's nothing that's going to happen where there's no money, okay? It's just less money that's going to be made available. So, but you got to understand, liquidity is like the oil that's in your engine and your car, and that's the oil that runs our economy's engine, liquidity. So that was a big problem today too, because when liquidity starts to tighten, they think he's going to tighten it, the Fed pulls money out, remember QT, and interest rates start going up, and banks reduce lending. The spread between the 10-year and the corporate bonds start widening instead of tightening. So just a lot of bad news that everybody just, it should have been 1 to 3, instead it went from 1 to 100. And then, now gold, remember, fell about 6%. And that's what I told my gang members. I said, you're going to get cuts. They're going to be anywhere from 3, which we've been having, to 4. Then one day we're going to get a big cut. And so gold has already dropped about 6%, I think it is. Now, so stocks get volatile when that happens. Rallies start fading. So the big tech stocks get hit. They get hit the hardest. And that's what we saw going on with tech this morning. So this market just sold off. But let's get to gold. So again, play that cut again, because this was lighting everybody's hair on fire.
And the world is now pulling the rug out from under the U.S. The dollar is going to collapse. The dollar is going to be replaced by gold. Central banks are buying gold to back up their currencies. True. They're getting rid of dollars. They're getting rid of treasuries. We are headed for an economic crisis, again, that will make the 2008 financial crisis look like a Sunday school picnic. The biggest difference between the crisis that we're about to have and the one we had back then is this one is all in America. It's not going to be exported to the rest of the world. It's not a global financial crisis. It's an American financial crisis.
All right. Now you can put the hair that's on fire out. First of all, gold, now, what he's saying is completely right. But let's tone it down from 100% down to about 2%. Because here's why. Gold and the dollar are two different jobs. It's like being a mason, okay, or a brain surgery. They have two different jobs. So the dollar we use for trade, we make contracts, debt, banking, all that. I mean, remember, it has its own job. Now, gold is money, but it's not a working currency, we'll say. The dollar, so you have gold over here, it's money, but it doesn't work. What works is the dollar is the working currency. So you see, there's two different jobs here. So this is a little extreme what he's saying. Now, they're different tools. They're like a hammer and a screwdriver. So the global financial system, also, you got to understand, is built on the dollar. It's just not going to go away. 90% of our global trade is the dollar. It's just not going to turn overnight. And 60% of all the reserves, the global reserves, remember, that's held in dollars. So when they say, the central banks are dumping dollars, no, they're not. I mean, sure, they're dumping treasuries, they're dumping dollars, but not to an extreme, because you can't replace all that with gold bars. You can't. It's impossible. So, remember the plumbing. Think of it as the plumbing of the world runs on dollars. Do you know what they have to do to flip this thing upside down? One day it's going to happen. One day. It's not going to be in my lifetime or your lifetime. I'd be stunned if it was. And another thing is about gold. Gold is an insurance. It's like an insurance policy. Central banks buy it because it's like an insurance policy. It has no. They don't have to deal with the counterpart. They don't have to deal with anybody. They don't have. It doesn't have to be anybody on the other side. They deal with it. There's no other guy. There's no counterparty, as they call them. You can't freeze gold. I mean, and it hedges all this risk, all this long-term risk we have. There's a hedge for all the risk that we have. That's what gold is. So everything has its own place, and you can't just pull one piece out and all of a sudden don't think everything's going to. It's not going to happen. Now, and that's why I'm looking at gold today, and I'm just saying to myself, everybody's going nuts and dumping it. Now, there's going to be those going to come in and buy on a dip, buy on a dip, buy on a dip. Well, you don't want to do that. Now, let's go to my chart, and I'll show you why. Here's what you want to do. Okay, so let's just take one of my gold stocks here that we own. Where is it? All right. So let's just take here. We'll just put it right here. Let's just take GLD. Okay. Okay. So let's take a GLD here. All right. If I can get going and find it. Okay. So here's GLD. All right. Now, what happens is when you get this big drop, people start to panic. What you want to look at is the volume. If you get these big, large volume bars, okay, that means think of it as like a green light. It's a green light, okay? That means it's going to go back up, but the big reason it's going to go back up is because if you look at the trend of it, it's so strong. Until that trend breaks that 80%, this is 80% line where the stochastics start to roll over, it's just going to go back up. So what we do is we tell people, here's what you do. Let it pull back, okay? The test is at the top, not the bottom. So let it pull back. That's what you want. Let it pull back, and then let it rally, okay? Let it rally. And then the next time it pulls back, when it pulls back right in here, and you have your low, and you have your higher low, and then when that takes off, okay, as long as you got the volume, now that takes off, and it'll break nicely right through this high. That's where you want to buy it, right at the high. You don't want to be buying it on the dip. You got a better chance of going from $450 to $600, buying it up here at 504 than buying it at let's say 556 if it starts going up. So the point is, you always, on anything that pulls back, don't think, I got to get in here. I got to get in here to get up to there. I got to get in here now before it gets up to 504. Get me in at 432. No. You're working against yourself. Comes down, let it rally. You want it to go up about a third of the way is the best. And then it's going to pull back again. And when it pulls back, as long as it's higher, as long as you got this right here, like this, look. As long as you got, there's your low, there's your higher low, then you wait till it breaks out there. So that's how it works. So these dips, and you're going to buy in a dip, you better be buying on a solid uptrend. You want to buy on a solid uptrend. So that's where we are. So again, all the stuff going on today with the tech, and this is another thing that's going on. Everybody is taking tech stocks, dumping tech, and they're going into banks, right? Well, watch this. Let's go back to my chart. Sorry, I shouldn't have done that. Go back to my charts. If you go and you look at the banks, let me show you. Boy, they're making some mistakes. Not all banks are equal. Everybody, the gibberish, get into the banks, right? They're not all good banks. So let's say you go, people have been buying J.P. Morgan. What are they, nuts? Look at the downtrend J.P. Morgan's in. They're in here buying it. What are they, nuts? It's going to come right back down until the trend changes. So you don't go and buy J.P. Morgan. You don't look at Bank of America yesterday. They went nuts. They were buying Bank of America yesterday. But look at the trend. It's down. You don't buy on dips on down trends. You buy on dips on up trends, not down trends. So if everybody's going to get hurt buying into these bank stocks. Now, if you get a bank stock, okay, that's a real strong stock, okay, that's fine. And there's quite a few bank stocks that are really strong, but they're not the big banks. They're the regional banks. Those are the ones. Like, for example, if you look at Citibank, right, or you look at Morgan Stanley, the ones that are strong are like your Key Bank, your PNC, your COF. I mean, not COF, TFC rather, Truist. So when you hear them say, "Get out of," you got to go to banks. You got to go get out of tech. You could get, if you get the wrong bank, you're screwed. People, that's why we're here to help you. PhilsGang.com.
Are you nuts?